Thank you all for being here. Steve, I see Steve M. from your AOK from Boca Raton. Wow, I tell you what, raise your hands if you're in Florida, north, south, east, or west. Raise your hand, because I'm certainly here in North Palm Beach, Florida, and I got to tell you, it looks like almost like living in Chicago in November. A lot of dead trees and leaves on the ground. I mean, except for the weirdest thing, it's all brown. So if you're down here in Florida, even though the really feel for the folks down on in Naples and just all over from Cape Coral over in Fort Myers, it was a mess. But we were lucky, Steve. We were lucky as well. No structural damage. It's just landscape, putting everything back, and just crazy. So anyway, wanted to welcome everyone here. What we do is once a month we have our PUG user group, person user group. It's a TradeStation forum platform, and we go through some of the indicators that we've created and how they're best used and the functions. And I think all traders alike can benefit, because a lot of it has to do with the work that we did with between the high close doji, the PPS indicator, the scans that we use on various platforms. Of course, everyone knows my favorite three: TradeStation, Thinkorswim, and Trade Navigator Genesis. So with that said, we will begin right away. Subject du jour is a couple things, and we'll go through some house cleaning later. House cleaning, they don't have dead palm trees in Chicago. Alan, you are correct. I'm sorry I didn't get interrupted there. I like that one. You know, that was the only difference about Florida and Chicago besides snow. There are no palm trees in Chicago unless you look at the fake ones inside. Florida, you don't have snow, and you also do not have the Italian beef with hot peppers from like places like Portillo's or Big Al's, which is something I sorely miss. Now I'm going to be salivating as I talk. It's just an incredible culinary delight in Chicago is what it really is. But anyway, nothing like 1-800 Lou to go. That's a Lou Malnati started a little service, and you just go 1-800 Lou to go, or Google it, and you can order, which we do frequently, pizzas and Italian beef kits. Anyway, all right, enough said. Where are we going, what's happening, and what tools do we use in the marketplace? Today, I'm just going to get a quick idea of what happened with Best Buy, BBY. It's kind of funny. Today, they had an investors, the first, is it reported? If I'm inaccurate, please stand up and correct me, you know, for the sake of speed and efficiency and going through a lot of material that we need to go through. I may not have all the facts 100%, so I don't want to be giving out any fake news. But I believe Best Buy had the first Investors Day conference in 5 years. Didn't go so well. At one point, it was down 9%. But what we identified in the room, so I guess the first thing you would say is don't hold any more Investor Day conferences. Stick to just what you've been doing. Let's look at a couple things here on some tools that we use and we've created in the TradeStation platform. This is a weekly chart, and this is something that we've gone over before, and has, again, not any one single indicator is picture perfect, but combination of different indicators in this, what I call contrived algorithmic traded world, and an insatiable demand for everyone's student body left being in equities right now, I think is very important. The first thing is, obviously, this is a weekly chart, and this is using, with, as you can see, the buy and the sell signals, or the bullish and bearish indicators. Those are the PPS indicators, and then the horizontal lines that you see are the person's pivot indicator. The white lines that you see being drawn, that is actually something that I wrote about in my second book exactly 13 years ago, called The Last Conditional Change. Specific candles, when they have breakout modes, they lows of those candles act as support, and when they have breakdowns, the highs act as resistance until a new one takes place. And so those are the gray acts as resistance, white acts as support. So that's what you see on your price chart here. Just to explain the landscape of what we're watching. This is a volume indicator which we often talk about for our PUG Persons User Group members. This is an indicator I created that kind of balances in terms of a momentum of volume rather than price, and in terms of percentage change rather than actual change. And it gives, I think, a little bit better visualization of the condition of volume on rallies, such as divergence patterns. So if we get moves to the upside and over time, when you can clearly see a convergence, that gives us a warning sign that something, there's a change coming, to avoid the stock from the long side. So on a weekly basis, Best Buy, even though it had some decent moves to the upside, it's been sitting here struggling up against that 60 for actually a while now. And then looking here at the very bottom, this is a really incredible, powerful tool we call it the Person's Market Catcher. Many of you may have been around when we introduced that earlier this year. It's a relative strength indicator that detects the market in 4 stages or 4 conditions. Improving, or outperforming, which is bright blue. Still lagging the over market, which is falling, which is blue. And then lagging the market, which is red. And then improving, which is fuchsia. So it gives 4 different conditions of the market. What we want to see is if a market is going to continue up, then we want to see the volume moving up, and we want to see the relative strength moving up. And that'll give us a better clue as to help guide us whether we want to be in the trade or not, or if there's more longevity. So in Bed Bath & Beyond, what's interesting is that as we were getting into this little gap area as it was making newer highs on a daily chart, you could clearly see the divergence on the volume. It was warning that something was going wrong here. And in addition, the relative strength was weakening. And then, of course, the bottom fell out. And then the same thing could be said here. We don't have a true positive reading in both either the market, and I guess at the very least, many of you will say, gee, person, stop writing like John Madden. But you will see that at the very least, the market was getting near a person's pivot resistance. Which one? That's a monthly pivot. As you can look down at the calendar, you can see that is a month time frame. So what's ironic is that the monthly person's pivot was targeting a lower green and a lower red. So we had several different indicators. So again, it's a pattern. A pattern is not in my work, or at least looking at helping to navigate in this world, which is absolutely crazy. Think about when I say crazy world, look at the way the market traded today. We had what? A 6, just to be official. Let's take a look at something, gang, so that you know what we're dealing with here. This is the E-mini S&Ps. This is the, biggest, baddest boy on the block, right? And as you can see today, and still currently, from 01 to 06, that is from 01 to 6, subtract the difference, and you have a 5 handle, 5 points. So we finally made at the end of the day, we kind of had a little uptick and punctured our head up to 06. But all day long, from yesterday, last night's Globex opening, this is the Globex 24-hour session, we had a 5 handle, 5 points. That's 20 ticks. Earlier I tweeted out it was 19 ticks, when right now, which is a very low average true range, so the ATR is 13.3. So we have a kind of, in fact, if I may, on the day before Christmas Eve last year, December 23rd, we did this in our trading room. Many of you were there for this day. We had actually a 6-point range on a Friday, December 23rd of 2016. A 3-day holiday weekend ahead of a holy religious holiday, Christmas, right? And we had a bigger range the day before Christmas on 2016 than we did today. Now, what could we look at that? With everything happening, like we had Best Buy down 9%, we had Wynn up 3%, we had the pharmaceutical companies flying around, mostly negative on the day. Energy was moving just a tad. President Trump was addressing the UN. There's a lot going on in the world, but the volatility just dried up. That makes it for a tough trading session for most traders looking at the overall landscape of the market. So again, we need to I always teach people, if you're going to figure out where a market might go, you got to ask yourself where it's been. Now, I didn't invent average true range, but we certainly did add it to our radar screen for a very good reason. And that way we could kind of tell, are we in a low implied volatility as far as trading range is concerned? I mean, define volatility. It's trading range, really. Narrow ranges, no volatility. Expanded ranges, that was the definition that Wells Wilder, if you guys remember Wells Wilder, he's really famed for creating an indicator overbought, oversold called the Relative Strength Index, RSI. So anyway, a little bit of history lesson there for you as to who's helped popularize certain indicators. Now, when we're in such a really tight range, that makes it for tough trading. And so I think the first and foremost, again, find out what's the kind of market environment we are in. Are we seeing a heavy volume day on a wide range or overexpanded range day? And looking at the TradeStation's radar screen package, we have a couple parameters that or data sets that I like to look at. A, what's the volume compared to historic volume or recent historic volume? And what's the current range versus the average true range? And as you can see, even today, man, our average range over the last 2 weeks or volume has been 1.3 million shares in the E-mini S&Ps, and today we did 948. Now there's still about 18 minutes to go before the session ends, but I don't think we're going to change a whole lot in that time period. We can kind of take a look at a lot of big things. For example, Facebook, it's off its volume, and the list goes on and on about a lot of different sectors. So what I like to do, and we had a guest in my office yesterday afternoon, someone that had been a Trading Triggers University student from over 10 years ago, who gave us a highly acclaimed credit for his education. And he came to the office yesterday, and it was so nice to see Eduardo. And the moral of the story is to sit there. He says, you haven't changed. You still have the same concepts. And I was like, yes, I don't have a new indicator. I just look at things in different perspectives because it still works. That's a very powerful statement. A lot of people come up with a new indicator every week almost because, I don't know, their other indicators didn't work. But this is one of the most powerful tools, is the consistency in which it works. What I think has changed, and why this particular, for PUG members, why this is so neat, is that we can kind of take a look at opportunities in the market, and now we have different ways to trade them. All right, let's define what I just said, different ways of trading them. From 10 years ago, we identified, well, over 15 years ago, high close and low close doji. We identified and created the PPS indicator close to 15 years ago now. The last conditional change, boy, that's older than dirt. That's something that I wrote about in 2004, so that's 13 years old. So that's the basis of what we use. Now, what's changed? Right here, gang, sector ETFs. Wow, when I wrote my second book, this thing called the FXE was just coming out, and I wrote about it in chapter 1, and I said, boy, stock traders can look to trade the euro currency by the FXE. And now we have ETFs on natural gas, on crude oil, on the coal sector, on solar energy, Here's one for the ages right now that's a big thing that's changed in our universe, and I think this is something that we probably need to address because I don't think it's going away anytime soon. And if you just visited us for the first time, I want everyone to kind of take this symbol down. It's the GBTX. It's a Bitcoin investment trust. I mean, they now have an ETF or an ETN on Bitcoin. Can you imagine this? So that's kind of, now, again, if you're going to figure out where a market's been, ask yourself, or where it's going to go, ask yourself where it's been. It's not one of the more liquid products. It did trade 68,000 today versus 73 on average. So that's what I'm drawing there. That's the average. That was an arrow. It's a bad attempt at an arrow. And so I can kind of take a look at what the range is on a given day. I mean, look at this look at this beast. The ATR is, over the last, say, 2 weeks, has been 111 points. So there's something there for everyone today. And if you take a look at the range today, from 675 to 744, we were shy of the ATR. So it was a light volume day and a narrow trading range day, even for Bitcoin or the GBTC. So that's kind of a new way of looking at trading Bitcoin, and this is gaining traction, gang, and we'll get back to that in just a minute. So we've added that to our list. What else has changed? Well, I mean, we have all types of different ETFs, sector ETFs, of course, the S&P Select Spider, industrials, materials, home builders, energy, financials, and then we come down to this, ways of trading the market via leveraged and inverse leveraged ETFs. And every you guys, a lot of you can give lessons on this. You've seen this around. This is nothing new. But we've expanded the amount of ways we can trade a market to custom tailor the financial community's needs to service investors, because 401ks can't go short. So, okay, let's create an inverse leveraged ETF to get around the short rule. Okay, so there's QID. Let's make it so that we could trade the financials and get into more specifics like the Financial Bull 3-time ETF, which is the FAS. So we all have different ways of trading a market. What's not new is the low close doji or high close doji. But how we look at the information and correlate it and extract the data quickly, that's changed. And that's what this whole thing about using the long-term radar screen is all about. So we not only can get, not real-time, but it alerts in anticipation by blinking. By the way, if it's close to the close and you can just quickly scroll up and down, and I can find out how many stocks not are just going negative on the day, like an entire sector like biotech today went negative, right? It's all red. It's, you can see it looks ugly, right? But it didn't go that red. What I want to find out is not, everything might turn negative and have a downturn, $2.73. How many of these stocks actually were so negative they created a algorithmic change by creating a sell signal? That's kind of important. By the way, the IBB did generate today a low close doji. Let's validate that. Let's click on IBB. So there is a algorithmic, we've been in a daily PPS sell signal for the last 3 days, and note that today, this is a line in the sand. That's the last conditional change support, the LCC. We actually closed below that level. And volume wasn't that great. Relative strength is disimproving. It's weakening against the overall market. So we may be looking for more relative weakness in the next couple days. Pay attention to the IBB weakening over the next couple days. All right, let's take a look at, while I've got everyone here, just to share with you how I utilize this information. How does the higher time frame information match up? Well, I mean, it's kind of spotty with the IBB, and this takes the relative strength condition, ranks it, puts a numeral value on it, and tells us that on a weekly basis, the volume is kind of not looking too great. You can see the trend of the volumes going down while the price went up. That suggests we have a weak volume rally, and it is susceptible for perhaps decline. So we want to pay attention to the short-term daily charts and see if it cascades into the end of the week into a weekly sell signal, and we could see more declines in the biotech. So that's how I utilize that information. Today, by the way, many of you guys, if you were in the trading room, how many people were in the trading room today that when we were discussing taking a short-term opportunity, looking at when Best Buy was down near 9% on the day? By the way, if you utilize your person's pivot study, it's called PPS, the PPS indicator, and those are the arrows. What we talked about was a couple things. Was we had strong monthly pivot support, and I said, wait till we get down near the monthly pivot support, look for a last conditional change breakout, a gray line, a close above that. We had a little slight trend line, and look at the volume. You see this level right here? Now, it didn't show that in another tool that we've popularized called On Balance Volume. We'll bring that into the scope for you so you can kind of look at the helpfulness of this. Clearly, when the market's making this low today for a scalp, and that's all we were looking for, literally, there are two volume indicators on your screen. This is OBV, and this is the person's volume indicator. And I've said it, and I make no bones about it. I rely on more than I do this. Why? Because it helps to illustrate, due to the changes, not in net positions, because of the construction of on-balance volume, it assigns an entire bars move down or bars move up, the entire volume. It's still a good tool, don't get me wrong, but this indicator that we created in terms of percent changes and giving this histogram reading shows a stronger identification of bullish convergence. When the market made a newer low from a prior low, I mean, it was pretty significant. I mean, no big deal. I mean, but, you know, $2 on an intraday trade of a market was a kind of a nice little uptick move, especially looking for an intraday swing. So that was kind of what we were looking at in Best Buy today, and how we nailed that, not just the exact low, but it was the condition we were looking for, the pattern. The pattern was right. The momentum was turning less negative, and the volume was showing bullish convergence. So that was a nice little, you know, in a day where the E-mini S&Ps gave hardly any trade opportunities, it was a very difficult trade as far as looking for volatility moves in anything, whether it was gold or crude oil had a quick goose up and then down, or down and then up, excuse me. But other than that, gang, putting together these tools and how we're using them in today's environment, besides the different ways that institutions are trading the market, it allows us to interpret the data with lightning speed and get clearer cut vision of market conditions. So that's kind of cool how the TradeStation, I mean, radar screen's been around a very long time, but to be able to put together these tools that can say, oh, and by the way, if you get a low closed doji and the market's weakening with relative strength, which is right there on our board, right? So we want to see if that relative strength continues to disimprove relative to the S&Ps, then we'll probably see a lot more of these stocks start to cave in, and that is something that going forward would weigh in on maybe perhaps if there's more relative weakness in the biotech space, that's going to weigh in on an ETF we're all familiar with called the NASDAQ 100, which is up close to around 24% year to date. So this is the on-balance volume, and you can kind of see as the market's rallied, it's certainly not breaking out with a fortitude of volume. And so what makes this index tick? Software like Adobe, biotech, Apple, Amazon, Facebook, right? Those are the big leadership weightings that affect the pricing on the Qs. So a couple things that we're going to be looking for is to see if the cumulative advanced decline starts to weaken, and if the heavier weighted sectors to the Qs, like biotech, start to go down. It may give us a clue that we're going to start to see maybe another pullback in that sector. So this is how we kind of are able to utilize the radar screen a little more efficiently. Now, it's the middle of the month pretty much for the most part, but it's also the end of the quarter, right? It's all the end of the third quarter, and if I'm not mistaken, it's going to be, what do we got? Another 5-8 trading days left to the quarter. We have Wednesday, Thursday, Friday, Monday, Tuesday, Wednesday, Thursday, Friday, with, by the way, tomorrow night at sundown, the beginning of the Rosh Hashanah Jewish High Holy holiday for the week that goes into Yom Kippur, which lasts until Saturday, the 30th of September. So this is not traditionally we're going to probably miss some participants in the marketplace, number one. Number two, we have a German election coming up. I don't know if anyone's aware of that, but on besides tomorrow's most obvious FOMC announcement, how much the Fed's going to reduce their balance sheet, if their Fed's going to raise interest rates, they certainly have every opportunity to raise interest rates. And by the way, I'm going to add a little conjecture here. Does everyone remember, or maybe it's a polling question, not conjecture, does everyone remember about 2 summers ago when Aunt B, as we affectionately call her, Janet Yellen, sat in front of the Senate Finance Committee in her semi-annual testimony and claimed that she thought that the equity market was a little overstretched in value? Does everyone remember that one? She had actually made mention that the U.S. equity market, she felt, was perhaps a little overstretched in valuation. It was about 2 summers ago. I think it was in the mid session. I think it was July, I believe it was. So if that's the case, I wonder if that was over, when was that? That was way over here. It might have been there is when she made mention. If she made mention of it back then, I wonder how she feels about the market up here. All right, Don, thanks for your feedback. Yeah, and the head of the FOMC actually made mention that she thought that the U.S. equity market was slightly overvalued. If it wasn't at this, I don't think it was here before the little pullback. I think it was after. It was over here. I think it was in 16. That's something that's Googleable. What's the point I'm trying to make? Well, if the equity market's up, it's up on corporate earnings. Jobs have we've seen an increase in slight wages, not wage cost inflation pressure, but we've seen, some argue there's as much jobs as can be created until, we see an expansion in manufacturing here in this country. And I'm not going to here to debate that, but the Federal Reserve certainly has really no excuse for not raising rates tomorrow. If they really wanted to, people would be like, yeah, fine, everything looks good. There's building going on. Everything's going well. The stock market's up. And yet they have this quantitative easing because they don't. Maybe if they don't, I'm not sure it sends a message that the market's got something more to worry about. But at this point, just like in the overall marketplace as we saw with the Qs, the cumulative volume move, as we've seen since, let's call it July, the summer this little move here has really come on the heels of lackluster volume. We've made a newer high in the market on a lot lighter volume in terms of percent changes. And that, to me, friends, I mean, I'm not going to tell you we're due for a correction. I think everyone probably knows that. They just don't want to, you know, miss the opportunity that this thing's going to go up forever and miss out on profits. But I would have to say the radar screen and the tools that we have to look at, whether it's the participation breadth of the market and the volume, and also the fact of identifying that we're coming into, at the end of the quarter, we're up against a lot of different markets near both two things: monthly pivot, person's pivot, and our quarterly pivot resistance. And we could see that on this radar screen. So to say, gee, is the market fair priced or overpriced over time? In a given month, and it's middle of the month, we are already at projected pivot resistance targets and exceeded close to quarterly pivots for other segment ETFs. Maybe we're at a wall of resistance, and the more sector ETFs that we're at, or more sectors that are at a wall of resistance, right, as we enter a new time frame, I think we owe it to ourselves to really take a look at that a little bit more closely, and that's what this whole package allows us to do. In addition to that, there's other products that we are now trading in the, and I wanted to get and address that right now in ways of trading the market. It's not just leveraged ETFs. It's also this stuff right here, gang, Volatility Products. So we have the VIX, which is not traded. It's just an index ranking numerical value on the bid and ask, or the spread relationship or demand between puts and calls on the S&P 500, let's say. So it's a derivative of derivative of a derivative, okay? But then we have ways of trading volatility with a leveraged ETF, a shorter term, intermediate term leveraged ETF, a inverse leverage, the SPXY, and then the ETN, an exchange-traded note called the VXX. This is one that's, as you can see the volume here, gang. Look at the volume on the VXX, 22 million. Now, this just recently had a 4-for-1 reverse split. So if you think about the numbers there, about a month ago, this was trading over 100 million a day. So now that it's a $41 instrument, it's trading 22 million. Again, today it was lower than its normal volume over the last 2 weeks. But needless to say, we have so many different products that we have available to trade. It's mind-blowing between Bitcoin now, volatility products, sector ETFs, individual stocks. We have to rank what we want to trade because obviously we can't trade everything. So in the spirit of looking at certain things, this is, we've shared this before. We did it back in May at the Traders Expo. I don't know if anyone was there at the May Traders Expo. It seemed to be a projection issue, and hopefully we won't have those problems this year. But I wanted to share this volatility product, and just to let you know, and I'm going to change and get rid of the candle patterns. And you can kind of see two things here. If it's red, that's a loser. If it's blue, that's a winner. That just kind of tracks where the signal came in, what the trade actually did. This is based off a 60-minute chart. So when you look at this product, this is the actual, well, here, I'll just share it with you here real quick. This is since almost its inception to the beginning of 2010. Many of you are familiar with performance graphs. If something starts off at the lower left and goes up to the upper right, that's pretty good. All right, that's like really good. Okay, that's a performance of a product that's capable of trading not just from both an automatic entry system, which will enter in when you get short, what your risk is, and then define your profit target. But it has a significant amount of performance behind it. In fact, periodic returns, just to share with you guys. I mean, this is based on $100,000. You can obviously trade this in increments of 10,000. So the very first year, if you started with just simply $100,000, the back test on this was positive 75,000. The second year, 45,000. Third year, 129,000. The fourth year, 89,000, 45,000, 91,000, 57,000, 66,000, and then you know, here we are year to date, 65,000, and that's a pretty substantial rate of return. What I'm really kind of also interested in sharing with you is, you know, nothing in this world is perfect. You know, you're going to have setbacks. You're going to have what's called a drawdown. How much is a drawdown? You know, the worst thing about someone trading a new product off signals is it has a heck of a run. It has this huge burst of profitability, and the minute you start trading the darn thing, you know, volatility collapses, it stops giving good trades, and then you go into a drawdown period. No one wants to start trading something on a new drawdown period, right? So what is the maximum drawdown that it's had? 20%. 20% is the maximum drawdown. That's pretty staggering for a product as volatile and as kind of unique to our culture as this product is, the VXX. And I don't think this is going away anytime soon, gang, because it's the newer way of trading. Of course, now we've got the secondary wave of new trading called Bitcoin coming in, and the ETN, or the product that they have that I introduced to you a few minutes ago, which here is that little market here. Let's take a quick look at this thing. In the last, I mean, it's not a great setup. It's only traded like 200 times. Percent profitable is about almost 80% using the person's indicators. So it's not that bad. It's just when you take a look at its trades, I mean, that's account size based off $6,500. So it's, you know, since, again, keep in mind, this is since March. I mean, this has not been something that's been around for 100 years to back test for the last 10 years. But I think as we start to move forward in the Bitcoin era, this is the spider. What happened to my Bitcoin? Let's go back here and find that. Where did it go? Here it is. Oh, well, this is a little bit different. This is in the last month and a half. It's a little off the chart, too. It's percent profitable is about 57%, excuse me. And this is based off I mean, I would not tell anybody in their right mind to trade this ETN with $1,500. It's just not responsible. So don't even look at it that way. What I want to look at is are the signals valid? Is it a tradable product? Number one. Those are the kind of things that we look at before beginning to trade a market. What is it that we are getting into in the new era of trading? And these are those products that hedge funds will be moving into besides trading equities. So in any event, I wanted that everyone can kind of see the performance graph over the last month and a half, which is really pretty decent in of itself, you know, in looking at the signals for this type of product. And this would be more of a swing trade. It, as you can see, takes both longs and shorts. So the trade station and the indicators that we developed, what's really unique about it is that at the end of the day, we created indicators that have not only stood the test of time, whether it's the S&Ps, whether it's bonds, whether it's Microsoft, whether it's Amazon, but it's now these new era products like the volatility index that's providing ways to trade. What What I think people really need to do is to kind of be able to open their horizons and expand into, hey, what's out there? Is this for me? And maybe people need to learn about not just the new products, but ways that you can trade them. And that's kind of what we've got going on here with the stuff that we work with. And so coming into today with looking at the PUG users group, the first and foremost thing that I like to do is to say, how do we start and how do we translate that to good executable ideas in the marketplace, right? Number one. And that is our analysis still uses some of the 4 data points, and you can see 2 of them here. The high and the low, the open and then the close, right? So we still all use high, low, open, close. We still look at volume. Average true range is kind of an important thing. After all, looking at what the high and the low, which Wells Wilder did, is he said, hey, give me the greatest distance of the high-low to yesterday's close, and that's the true range of the market. Average true range is just what's the true range over X period of time. In any event, looking at pivot point analysis, my favorite tool, a lot of people say, oh, he's the pivot guy. Well, it is true. We helped create and popularize pivot points, but there's a lot more to trading, and now I think it's just a matter of keeping up with the market, keeping up with where the smart money's going, because that's what we want to be in. If we stick around and look at E-mini S&Ps every day, that's going to be I think it's going to be a tough living. We've got to be diversified. Why do I say that? Because the E-mini S&Ps, when you stare at that type of range, this is unprecedented, and we've seen that a lot this year. What else have we seen this year that's a little fugazi? I'm going to tell you right now, the market moves when you least expect it in the overnight session when nobody's trading it, except for maybe the guys in the UK and the UK hedge fund traders. And then we come into the US market, and then we get it trapped into this crap, and then all of a sudden you get a quick trade and it comes right back up. This has been the norm this year, not the exception. We've seen more markets giving better trades after hours, or and you don't have to believe me. Just go through and look. It's been more of a, believe it or not, it's been more of an overnight swing trading environment rather than a straight up day traders kind of market that we've seen in years past. Will that change? I'm hoping. I think it will. But the more products that we have, and the more globalization that's in the market, and the more contrived the market is by central bankers. And I think that we're all adults here. We all know that Mario Draghi and the European Central Bank, they're at odds with Italian bank sovereign debt. Greece has still got their issues. I mean, I'm not here to be a fundamentalist. I'm here to just point out the realism. The trade deficits that are ongoing, of course, the Bank of England just said last week, this is amazing, of all things, you guys remember this, the Bank of England, Brexit, remember it was going to destroy the UK economy? Our economy is so strong, we have room to raise rates here. And what happened as a result? The British pound rallied. Can you imagine that? So this is the British pound. And of course, here's the way the market responded to that commentary, and in terms of both the indicators. And I mean, I don't care if you're bearish the British pound, you're not going to be selling it until we get a reduction in volume and a sell signal somewhere and a breakdown of trend, like something up here, right? So you had a nice little sell signal there, a breakdown of trend kind of, and the volume went down. That's kind of what we're looking for if you get that. But here's what happened. Last week, the Bank of England announced that they have room to see interest rates go up, that their economy is doing well. Now, relative to the euro currency, no one saw that one coming. Remember, 2 years ago, we even had our previous president go over to England and said, don't vote on Brexit. It'll hurt your country. Stay in the Eurozone. They didn't listen to him. And yet, here's now the British pound outperforming. So you've got central bankers out there, which is surprising the markets, and we're going to get these surprise moves in the market. What we need to do is watch for, these little subtle buy signals that we get, and also the condition in which we get those buy signals. So, I mean, that's been a message that we have brought to our clients, and how these indicators are kind of working. So, anyway, these are the PUG user group is designed to help people to utilize more efficient tools faster so that you can make better educated trading decisions. And with the aid of what we have always thought retail traders would like, because many people struggle. Think about it. How many times have you looked and stared at a day trading screen and say, I'm going to get in on that trade? And all day long you stare at the screen, and the 1 minute you walk away, that's when the market hits and you miss the trade. So, I mean, here's like in euro currency terms, in looking at the market. This is a day trade system from the last 2 weeks. It takes a little bit of heat, comes right back up over time. What's the performance on this thing? 50% profitable. What does it look like over time? Not too bad, actually. Look at the account size required, $3,300 to hold positions overnight. Its trading period, 14 days, et cetera, et cetera. Still profitable, not the greatest. Gold market. What's it look like? Gold's been actually pretty wild. Same time period from the beginning of September, since Labor Day. So month to date, not too bad. Performance graph hasn't really had a bad drawdown in gold. What has it done? Has it just been all buys? No, it's taken buys and it's taken some sells, right? So there's your profit factor off the charts. Obviously, you have an average profitable percentage over 50%. Does better. It's done better with the shorts, but needless to say, account size required. Again, I do not suggest anybody start trading gold futures with $980. It's just ridiculous. But I mean, look at the drawdown factor as initial capital. There is none, because it's just done so well in its signals this month. So is this something that is attainable for individual investors? And the answer is absolutely it is. And so I think that TradeStation and the PUG group, what I bring to the table, what my 30 years have done is I have not wavered in any of my teachings, I don't think. I have not dropped or abandoned any of my indicators or my style of trading. If anything, I've tried to adapt and change, keyword, adapt and change for the upcoming products that are there, and identify that money flow. Is it going from commodities? Is it going to equities? Is it going to ETFs? And now, obviously, we have a major switch with Volatility VXX. And then we're keeping our eye on this little Bitcoin ETF, because it's starting to rack up some good profitable returns from an automated basis. That's kind of what's really cool, folks. So with that said, PUG group, PUG members, try to get together and say, hey, what's working, what's not? Let's try to maybe clean things up. Let's try to filter out the bad trades. Let's try to amplify the good trades. Let's try to get this thing going, and let's eliminate what's unnecessary. So I have to tell you that in the overall scheme of things, when we look at how we trade markets and the indicators we have, listen, just as you see right here, you're going to take hits in the market. You're going to get stopped out. And yeah, it kind of irritates you, but knowing your system, knowing that, you know what, at least I'll take the next setup in if I get in. And that's the problem that I think a lot of traders have. They lose their confidence, they take it personally, or when they should be in the market, they're not, because they walked away that moment, and then the market moves, and then they go, oh, look what I missed. Or then they chase it, and when they should be getting out, they get in. And then they don't reverse. And I mean, I can't explain this. This is an algo-traded world right now. You guys all know this. I didn't make that term up. It's just that I think that we have the ability to help individual retail traders level the playing field more so now with this kind of product. So anyway, this is one of the reasons we come in and say, what's happening right now? What's the condition of the market? And where do we go from here? So the condition of the market is simply, we're coming close to the end of the third quarter. We have an identification that in the next 8 trading days, what we are going to do is we are going to be having a new month and a new quarter. And that's going to be kind of tricky as we head forward, especially after we have a high Jewish Holy Week and we have the Federal Reserve meeting. And a German election. This ought to be interesting, and to watch what happens after that German election on the 24th of September. And why is that? I'm here to tell you why. Germany is kind of anti-inflation. They're not big on the inflation thing. They had a little inflation problem back in the 20s. I don't know if you go back in history. I don't mean to be too sarcastic, but Germany had a little bit of a problem with inflation. This is a market that they say rising tide floats all boats. So this is the German, as you see, these are the foreign market ETFs. What's interesting is, let's go from a relative strength perspective. Japan, it's underperforming the U.S., but look at the monthly chart down here in your bottom left of the global markets. I mean, it's pretty steady. It's straight up. Looks pretty synonymous with the U.S. S&P 500. This is the iShares Europe ETF. Wow, this just spells the whole story. This is the UK. That looks pretty decent. This is the Eurozone ETF, a different version. That looks pretty rosy itself. This is France. This is the one called the emerging market, and that I want to look at with you right now. So the emerging market, it has actually climbed and climbed and climbed and climbed and climbed. And one of the parts of these E-series that we look at, that the ones that I just went through you, they're priced in U.S. dollars. So when the U.S. dollar goes down and their equity markets go up, it's kind of a double whammy that you get some return. That might be a problem as we head closer to the end of this quarter, because what I see in the market is we're heading up against a major wall of resistance here into the end of this quarter. So in addition to the emerging markets, and then again looking at various other aspects of things, while all the rising tides are kind of floating all boats, the question begs, what's going to deflate this party? I don't know, same thing I had to ask about what deflated the party here, right? When the market started to break out, obviously it came into a pause, and then, it got a little on the ugly side. Are we ready for that right now? Well, I tell you what, after a massive sideways action and it has recovered, I don't like buying resistance personally. I don't like buying. What I like buying is when resistance breaks out and then it comes back and the resistance acts as support and then it starts to resume. And then I'd say, hey, let's get on board this train ride. As it is right now, I'm not really all that thrilled about looking at jumping in on that train ride. This is why. So what would happen if we start to see repatriation of U.S. dollars in the marketplace? This is the dollar index. We're ending a quarter, we're ending the month, and here we are way back where we started in the U.S. dollar in 2015. In 2 years, with the Federal Reserve about ready to raise rates again and reduce their balance sheet. So how in the hell would we want to say, I'm going to continue to sell this sucker, the dollar index that is? I think we all need to kind of look at the longer term aspect of the market, and that's what the radar screen and the way we set up not just our charts, but the markets that we look at from a true professional standpoint. This is Italy. You've heard about Italian sovereign debt. Well, what looks funny about this chart? Here's Italy's market, and here's their old high way up here, and no wonder they're down, because something's wrong, not just in the overall Eurozone, but something's not right there. I'm sure you could see that. So while emerging markets, Turkey, for example, I'm not sure I want to follow into buying the top end of that resistance. This is France. France is actually looking a little bit, believe it or not, France looks a little bit better. Now, they just had an election, as you know. Macron is their new president. One thing I'd have to say, even using the on-balance volume indicator, it's a little questionable as the rally condition of this market. So a lot of these foreign ETFs are probably questionable as we end into the end of this quarter, which is in 8, let's count them up, 8 trading days, the old 8 ball. So, folks, we got a lot to look at and ways to look at the market. What I want to start to see is if these numbers and that relative strength from the person's market catcher indicator start to turn from bright blue to red. Red would not be good, okay? By the way, to sum this up, this is something we advised and suggested and kind of warned our community about was McDonald's. And it's been a lot of different markets this year that have this pattern, the same pattern, right? So McDonald's had one of the biggest down days as it rallied. They did the pump and then the dump, right? When they made a new high on the year, how did the volume look? Not so good. When they made a new high on the year, how did the relative strength compared to the overall market do? Not good. So pricing patterns between lower price and lower, lower relative strength and declining volume as a market rallies leaves a lot of I would have to say, room for the downside. Here's another couple, just a few names that I wanted to say, does this work all the time? Well, this particular year, I don't know if you guys remember, I'll take you through memory lane. Just back in May, remember when everyone loved Disney? Had to have it. Couldn't do without Disney. Couldn't do any wrong. See the new high? The volume was going down. Look at the relative strength. So as the market's breaking out and it's making newer highs and there's no volume behind it and the relative strength is weakening, good things don't happen to those type of stocks, right? The most famous one that I've done before, and I'll do it again because I think it's pretty funny, the sense of Warren Buffett in his famous interview when he said after the fact, when the stock was at 150, oh yeah, we got out near the highs near 180. This is where Warren Buffett claims he got out of the stock, IBM. 30% of their holdings he got out of. Look what the condition of the market is. It's making newer highs, the volume's going down, and the relative strength was negative. Yeah, Warren was pretty savvy there. American Airlines, same kind of concept, gang. As we start to see these stocks making newer highs, we can almost help avoid the stuff that's going to be disasters. And so when you start to see stuff making newer highs and the relative strength is weakening and the volume's diverging, those are kind of tools that we want to pay attention to, and I want to take everyone's attention to saying, yeah, this is really powerful, potent stuff that's helping us to avoid landmines and pick up some equity trades. So with that said, I want to thank everybody for attending. I hope you got something out of today's presentation. Are the indicators working? Obviously, yes. They're providing profitable trades. They're providing systematic development for algo automated trading systems. And so for a little house cleaning, by the way, gang, as we conclude this, a special announcement. We're doing a seminar down here, November 30th, December 1st, and the 2nd. And it's focused on algo trading. It's focused on my work. And if you're interested in attending, I strongly recommend to learn more about it. You can go to our website. It's right here. I'll force this into the, what's it called? It's called the text box right there. Focus in on that. and take a look at what we're doing here. If you're interested and you want to come down to South Florida after hurricane season, right, take advantage of this, and I think you will find yourself looking at a much better, higher developed education like you haven't had. And I really say that this is probably, again, based on our algo systems, our automated systems that we've developed on our criterias, this is going to be a phenomenal time for all. We'll be covering stocks, ETFs, and again, automated trading. So with that said, I thank everybody for your time and attending tonight. That concludes tonight's